Welcome back to Investing Talk Podcast.
Today we're looking at PayPal.
As usual, before we start, subscribe, like, and comment to this video to support the show.
It really does help us out.
And it lets us know what stocks you want us to cover next.
Exactly. And for today's session, I think we need to strip away a bit of the nostalgia.
Old eBay button.
Right. Everyone remembers that.
Yeah.
PayPal is the original way to pay online. But today, here in January 2026, we are looking at a company that feels like it's at a massive crossroads. It is no longer just a button on a website. We are looking at a massive, complex corporate pivot.
Pivot is the polite corporate word for it. Looking at the chart, crisis feels a little more accurate.
It does feel that way when you just look at the price action. I mean, the stock is hovering around, what, $57 right now?
Yeah, about that.
It's down about 36% in the last year alone. But this price action sets the stage for the classic market debate we need to solve today. Is this a value play where you're buying $1 for 50 cents? Or is this a value trap where you think you're getting a deal, but you're actually just catching a falling knife?
And that is the big question. Because let's look at the reality here. We're seeing an 81% drawdown from its all-time high.
An 81% drop.
That's a crash. I mean, that wipes out years of gains. And frankly, with the competition out there, Apple, Google, Stripe, I have to ask, can this fintech dinosaur actually dance again in 2026?
Or is it just going extinct?
Exactly. Is it just slowly going extinct while we watch?
Well, that's the skepticism that is keeping the price down, and honestly, it's the elephant in the room. But here is the counter-argument, and this is what we need to really unpack today.
Okay.
While everyone is looking at that stock price, the internal engine has changed. You have a company with a perfect Piotrowski score.
Which is a huge indicator of financial health.
It's massive. You have free cash flow growth that is, frankly, outpacing most of the S&P 500, and they have this hidden SI and commerce engine that I really don't think the market is pricing in correctly.
Okay, let's unpack this then, because if you're telling me there is a hidden engine in a stock that's been beaten down this badly, I'm listening. But I'm going to need to see the numbers. I'm not buying a narrative without the data. Let's move to the balance sheet.
Let's do it. So first off, the revenue forecast. We're looking at a projection to hit $36.048 billion in 2026.
$36 billion. Okay, that's a big headline number, but I want to know about the quality of that revenue. Is this just standard checkout fees?
Right.
Because that business feels commoditized. Everyone processes payments now. If it's just volume, I'm not that impressed.
That's the thing. It's not just the standard checkout anymore. If you look under the hood, the real growth engine here is Buy Now, Pay Later, or BNPL.
BNPL.
This segment is growing over 20%. Quarterly, they are on track for nearly $40 billion in transaction volume, just from that slice of the pie.
But hold on. Buy Now, Pay Later. We've seen other companies in that space, I won't name names, get absolutely crushed trying to make that profitable.
For sure.
It's easy to grow volume when you're giving away credit to consumers, but is it profitable? Or is this just empty calories? It feels like really risky growth.
That was the valid concern a few years ago. You know, the growth at all costs phase where you just acquire users and figure out the money later.
Right.
But here is where the data gets really interesting for PayPal. The transaction margins have flipped. We used to see negative growth there.
Meaning they were losing money to get users.
Exactly. But now we are seeing a stabilization at a healthy 6 to 7%.
6 to 7% margins on credit products is actually significant. That's sustainable.
It is. And because of the cost discipline they've implemented, cutting bloat, automating processes operating margins are expanding to over 19%. So to answer your question, no, it is not empty calories anymore. It is muscle. They are actually keeping more of every dollar they bring in.
Okay, so the margins are stabilizing. That's a good sign. But let's talk about the fortress itself. Because when a stock is down 80% from highs, I worry about solvency.
Of course.
I worry about debt. How does the health of the company look if we hit a recession?
It is rock solid. And I don't say that lightly. I mentioned the perfect Piotrowski score earlier.
Pause there for a second. For the listener who doesn't spend their weekends reading accounting textbooks, what exactly is a Piotrowski score?
Sure. It's a 9-point scoring system used to determine the financial strength of a firm. It looks at 3 things: profitability, leverage meaning debt, and operating efficiency.
Okay.
To get a 9 out of 9, you have to be improving in literally every metric. You have to be generating cash, paying down debt, and becoming more efficient, all at the same time.
And PayPal scored a 9.
A perfect 9. That is very raw for a company that is supposedly struggling. Usually, a turnaround story has messy books. This is clean.
Yeah.
And look at the cash. The trailing 12-month free cash flow is at $6.71 billion. That is up 99% from 2019 levels.
Hey, so they have doubled their cash generation since before the pandemic?
Basically doubled, yes.
That is a staggering number, $6.7 billion in free cash flow. That gives them a lot of options.
Yeah.
That's real money, not just accounting profit.
It does. And here's a detail people miss. Just from interest and fees on their customer balances, they generated $2.91 billion.
So almost $3 billion just for holding people's money.
Exactly. That cash pile allows them to defend against competitors, invest in new tech, and importantly for investors, return cash to shareholders via buybacks and dividends.
It sounds like they have the war chest to fight, but I have to play devil's advocate here. Who are they fighting? Because when I think of online payments now, I think of Apple Pay. I double tap the side button on my phone and it's done. I think of Stripe powering everything in the background. Is PayPal's moat actually wide enough to keep those guys out?
That is the multi-trillion-dollar question. But you have to consider the scale. PayPal has 220 million active monthly customers.
220 million.
And they are operating in 200 countries. Apple Pay is huge, yes, but it is locked to an ecosystem.
Good point.
PayPal is agnostic. It works on Android, iOS, Windows, everywhere.
220 million is a lot of people. But are they growing or just staying there?
Well, they're holding ground in a market that is exploding. The context here is the total addressable market. The digital payments market is growing from $15 trillion to a forecasted $36.75 trillion by 2029.
So the pie is getting more than double the size.
Exactly. PayPal doesn't need to kill Apple Pay to win. They just need to capture their share of that massive expansion, and they aren't just sitting still. They are diversifying into what they call agentic commerce and AI services.
Agentic commerce. Okay, that sounds like a buzzword from a pitch deck. It sounds like something a consultant made up.
Yeah.
What does that actually mean for the listener?
It sounds fancy, but it's actually quite practical. Think of the current internet. You search for a product, you click a link, you find a coupon code, you enter your details. It's manual.
Right.
Agentic means using AI to act as an agent for the consumer.
So the AI does the shopping.
In a way.
Yeah.
It finds the best price across the web, automatically applies the best coupons, manages the transaction, and handles the shipping details seamlessly.
I get it.
It moves PayPal from just being a button at the end of the process to being a shopping assistant at the start of the process.
Interesting. So they are trying to move up the funnel. They want to be the place you start shopping, not just where you finish it.
Precisely. If they pull that off, they become indispensable. They become the wallet and the personal shopper.
All right. The fundamentals sound surprisingly robust for a stock that's been hammered. But let's pivot to the charts. Because as much as we like the story, the price action tells us what the market is actually doing with its money. And right now, the market seems to hate this stock.
The charts are complex right now. That's probably the best way to put it.
Complex is a polite way to put it. Let's paint the picture. The stock is at $57. It has been a painful year, down 36%.
It has.
And when I look at the key indicators, it's trading below its 200-day moving average, which is at 66.19. It's also below the 50-day moving average at 59.62.
Right.
To a technical trader, that just screams weakness. It screams downtrend. Why shouldn't we just wait for it to hit $40? Why catch it now?
Well, you see weakness, but I see a potential basing pattern. When a stock trades flat or slightly down after a massive drop and stays in a tight range, it's often consolidation.
The market digesting things.
Exactly. It's digesting the new valuation. And remember, it is significantly undervalued compared to analyst targets, which are sitting around $75.
You think it's coiling, like a spring being compressed?
It looks like it could be.
Yeah.
We saw a recent intraday pop of 1.5%. Which shows there is some resilience there. It's not just falling in a straight line anymore. Buyers are stepping in.
What about the volume? Are people actually trading this, or is it a ghost town?
The volume is healthy. We are seeing about 15.1 million shares trading hands. That suggests volatility, yes, but it also suggests accumulation.
Right.
When you see high volume at the bottom of a chart, it often means the value hunters are stepping in and buying shares from the panic sellers.
That's the classic transfer of wealth, right? From the impatient to the patient.
Exactly. And if you look at the technical projections, if this base holds, and that is a big if, The target is $79 by 2027.
$79.
That implies a 40% total return from these levels.
40% is nothing to sneeze at. But to get there, you need the big money on your side. Let's pivot to what the smart money is doing.
Okay.
What is the sentiment out there? Because usually when a chart looks this bad, the institutions have already left the building.
The quantitative scoring is fascinating here. If we look at the sentiment score, we are seeing a mild bullish tilt. It's got a weighted score of about 0.12.
Mild bullish tilt. So they aren't pounding the table, but they aren't running for the exits either.
Right. You have sources like TKAKAR, which is bullish with that $79 target.
Yeah.
The Globe and Mail is bullish, focusing heavily on that Symbio acquisition.
The AI commerce play.
The AI commerce play, right?
But there are dissenters, right? It can't be all sunshine when a stock is down this much.
Oh, definitely. BTI is somewhat bearish. Their score is negative 0.209. They are worried about the 2026 margins.
And that's a valid concern.
It is. Their argument is that the investment in this new tech, the AI, the agentic commerce, might weigh on profits longer than people expect.
Okay, so tech pivots are expensive, but let's look at the whales. Who's actually buying?
This is where it gets really interesting. Bank, a major institutional player, increased their stake by a massive 766%.
Whoa, 766% increase. That isn't a hedge. That is high conviction.
Not at all. They now hold 363,000 shares. They aren't just dipping a toe in, they're diving in.
That's a huge move.
It is. And the teacher retirement system is also holding long. These are conservative long-term funds. They're looking at 5-10-year horizons.
But we have seen some selling too, haven't we?
We have. Arizona is down about 6%, and Stans, Ohio is down 8%. So there is some rotation happening. But the bottom line number is what matters.
The net number.
Net institutional ownership is high at 68.32%.
That is a key stat. Almost 70% of the shares are held by the big players. They aren't abandoning ship.
No, they are sticking around. And the analyst consensus on the street is a moderate buy. We have 20 buys, 6 holds, and only 3 sells.
That's a pretty decent ratio for a so-called distressed asset.
It is. And I think they are looking at the catalysts. We have the Symbio acquisition closing in the first half of 2026. That's imminent. And we have the Q4 earnings report coming up. And historically, this company beats expectations.
Okay, so the smart money is cautious, but largely supportive. But I want to do a pre-mortem here. Let's pivot to what could go wrong.
Let's hear the bear case.
Because I'm looking at this and I see a lot of risk. If I buy this at $57, how do I lose money?
Fair question.
First, margin uncertainty. You mentioned BTI. Their concern is real. If the return on investment for all this new AI tech gets delayed until fiscal year 2027, this stock is going to be dead money for another year.
The market hates wait and see.
It does. If the earnings report comes out and margins are flat, the stock drops. Second, competition. Apple Pay is terrifying. It is built into the OS of the most popular phone in the world.
It is seamless.
Stripe is the darling of developers. They're eating into that branded checkout dominance. If PayPal loses the checkout button war, what do they have left?
That is the existential threat. If they lose relevance at the point of sale, they lose everything.
And finally, insider selling. We've seen some insiders selling shares recently. When the stock is down 36%, and the people running the company are selling, that feels like catching a falling knife to me.
I see your point. Those are all valid.
Yeah.
But here is the rebuttal. I would argue that these risks are already priced in at a $57 valuation.
You think the market has already assumed the worst?
Look at the PE ratio. It is nearing a low 10 times earnings. For a tech company with these kinds of margins, that is bargain basement territory.
It's very low for fintech.
Usually you see PEs of 20, 30, or 40. Even if the growth is slow, you are paying a very low price for a very profitable machine.
So the downside is limited because it's already so cheap.
That's the argument. With 6 to 7% transaction margins and $6.7 billion in free cash flow, they can afford to fight a war of attrition. They have the cash to outlast competitors or simply buy new ones. They don't need to be perfect. They just need to not collapse. And the balance sheet says they won't collapse.
So it's a safety play in a risky sector.
In a way, yes. It's a value play on a growth sector that has been oversold. It's a mispricing opportunity.
All right, we've looked at the books, the charts, the whales, and the risks. It is time for the final verdict. We need to put a number on this. What is the score?
I am giving this a bullish score of 8 out of 10.
8 out of 10. That is high confidence.
Mm.
Give me the elevator pitch. Why does this belong in a portfolio?
PayPal is a cash flow machine trading at a discount. It is that simple. You have a 220 million user moat, you have a 20% plus growth engine in BNPL, and you have the upcoming Simio AI integration. The path to $36 billion in revenue is clear. You are effectively buying a dollar for 50 cents.
And from my side, looking at the data, I have to agree on the time horizon. This is a multi-year hold. If you are looking for a quick flip next week, this probably isn't it. The chart is ugly in the short term. But if you can stomach the volatility, the targets sit between $76 and $102 into 2027. The downside seems limited by that massive cash pile.
Mm-hmm.
It's hard to go broke when you have $7 billion a year coming in the door.
Exactly. It's about patience.
That's the verdict on PayPal.
Don't forget to subscribe, like, and comment. We'll see you in the next one.